Doctors, you sell your practice and the IRS can take almost half. I'm not exaggerating. On a $10 million exit, you could lose $4 million to taxes. Gone. 20% federal capital gains plus 3.8% net investment income tax and state taxes in places like California, you stack them together, you're staring at nearly 40% combined tax rate. But here's what most doctors don't know. You can restructure the sale to mitigate the tax bill, and you control when it lands and how big it is. Under IRC section 1400Z-2, you can elect to defer eligible gains by rolling them into a qualified opportunity fund. Here's where things get interesting. When that deferral ends at the end of 2026, you're not automatically taxed on the deferred gain. You're taxed on the lesser of your original deferred gain or the value of the investment at that time. What does that mean? If the value of your investment tanks later this year, then you pay much less in tax. That's not it. Now, layer that with a properly structured limited partnership. As a limited partner, you don't control the asset day to day. You can't force a sale. So that lack of control and marketability can support valuation adjustments, sometimes 20 to 30%. But these are advanced, highly scrutinized, and must be done by book, not guaranteed discounts. Used correctly, you defer the tax, time the tax recognition, and shape the economics without playing audit roulette. But how do I pay the tax when it comes due next year? In the right structures, you may access liquidity through distributions or a loan. But every move here has consequences and must be modeled carefully. And if you hold that investment for 10 years, all the appreciation after you invested can be excluded from tax forever. This is how the top 1% exit businesses. Not by avoiding tax, but by controlling when and how much they pay. So follow me if you want to design your exit on purpose instead of handing the IRS a huge check.